All right, welcome everyone to the Cash Flow Happy Hour podcast. My name is Josh Baldovino, and on this podcast today, we are interviewing Ryan Bakke, and he is a CPA out of Chicago who has absolutely just dropped so much knowledge bombs about real estate tax savings, and he has some unique strategies. I watched a webinar with him where he broke down why short-term rentals completely just are amazing for those who also have a W-2. So I'm so excited to bring him on, ask just the tax questions that everyone wants to know. And, from your baseline, hey, what should you do in your first year of real estate, to now getting a little bit more intricate. And then hopefully, right, if you guys want to talk a little bit more with him, you can schedule an appointment with him. But let me go ahead and bring him on the screen. Ryan, how you doing today, man?
Doing pretty well. It gets dark in Chicago here pretty quick, like 4 p.m. So it's been dark for like 3 hours now.
Are you guys at 3 hours? Are you guys East Coast time?
So we're 2 hours ahead of you.
Okay.
We're Midwest Central Standard Time. Yeah.
Gotcha. Well, sweet, man. Well, thanks so much first off for coming on. I really appreciate it. The first thing I have for you, one, right, with the Happy Hour podcast is, Ryan, tell me a little bit about yourself and maybe first, what's in your glass?
Oh, yeah. So what's in my glass is I'm drinking a Maker's Mark whiskey, and it's a bourbon whiskey. And I like bourbon. It's simple. It's about $30 a bottle. And that's because I'm frugal, but I'm not cheap. So there's a difference between being frugal and being cheap. And because like a lot of people, when they see my spending habits, they'll call me cheap. I'm not cheap. I'm just frugal. So my background is I was actually pretty bad at math in high school. I ended up getting D's, but something turned me on to the accounting and finance field. And I started doing accounting and finance in school. I studied 2 bachelor degrees. I was able to get all my schooling done in less than 4 years and get my CPA license pretty quick too. I did my public accounting experience that was necessary to get my CPA license. In different states, you need certain requirements. And so it started off working at a small CPA firm, doing a lot of real estate clients. I did Schedule C, small businesses, personal returns, bounced to a Big Four consulting firm. And now I focus on real estate clients.
Nice. So how did you get into tax? Like as a college student, do you have family that are accountants? Like what sparked an interest?
No. So I'm like first gen accountant, I guess, in my family. What really sparked my interest in tax as compared to audit or the other types of fields is just how you can see how the government can influence economic behavior by incentivizing people to do stuff in the tax code. So if they want people to invest in oil and gas, they'll make the tax code incentivize oil and gas. If they want people to buy more real estate, create more jobs, create houses for people to vacation to, they incentivize you to invest in real estate.
Gotcha.
And that's what sparked my interest in it. And actually, one of the first returns I prepared that really piqued my interest was I saw a married couple that made about $200,000 and they had a tax bill of about 30 grand. And then I saw this guy who made about 400 grand single, but he owned a bunch of rental properties and he paid less in taxes on 400 grand of income than the couple who made 200,000 did. So he's single, which means he's in a higher tax bracket. He made twice as much money, yet he paid less in taxes than a married couple that made half as much as he did. How does that work? And my boss said to me, it's because he invests in real estate.
And then
yep.
Was that in college or what?
That was when I was in college. Yeah. I was interning at a small CPA firm.
Okay.
And that just blew the door off. And I was like, I got to learn I want to know everything there is to know about this. And I've spent the last 4 or 5 years doing so.
I think it's interesting when you see the actuals, right?
Yeah.
When you're like on the back end, you know how much they're making, you know how much that's going in, that's going out, and you see what's real. I think one thing for me as I think about new short-term rental markets, like right here, there's a little teaser for another live that we'll be doing tomorrow where we take a tour of our Airbnb, is that, when you're just going into a market blind, kind of just trusting on what AirDNA or whatever, data things kind of give you as context, being able to see that person make $400,000, but then pay very little in taxes. Obviously it was just like, this is real.
Yeah, no. And like I said, as soon as I saw that return and I got it explained to me a little bit, I'm like, I need to know every single thing there is to know about this. because that's what I want to do. Right. I want to advise people on tax strategy, but then I'm not going to sit on the sidelines. I want to own my first investment property. Right. And so I advise clients on tax strategy. I do the tax strategy myself. So I walk the walk. I do it all. So.
And you did just close on your house hack, right? So you want to tell listeners a little bit more about what that house hack is and how you found it, how much you put down, stuff like that?
Yeah. So the house hack was a duplex in my area, which the area, what's happening right now, especially in Chicago, is there's a lot of people moving out of the city of Chicago because a lot of their companies don't require them to be in the office anymore. So you're seeing this mass like exodus from the city of Chicago, Illinois in general, but more so the city of Chicago, of people fleeing, which causes the rental demand in those suburban areas to increase. Because now you have these people that were used to making this amount of money living in the city of Chicago, paying 150% of rent compared to what they pay in the suburbs. It moved to the suburbs, increased the rental demand. And I bought a nice little duplex for purchase price of $240. And with the owner occupied financing, the 3.5% down, I was able to get a very low down payment. But the key is to get seller concessions. So it's to find something that's wrong, like something that's wrong with the property, but not enough to like make you back out of the deal. And so what I had the insider knowledge on was knowing the property was actually previously under contract. And the reason why the buyer backed out was because of the roof. The roof needed to be replaced. And so the roof, there was some electrical, there was some a little plumbing. But if you have, and that's the thing about real estate is it's an inefficient market. So instead of like the stock market, where if you and I look up Apple, we're going to get the same price. But with real estate, like you and I could come to a deal together, or we could be separate buyers and we could get a different deal depending on the financing, depending on our lawyers, our agents, and how we do the financing.
Very true.
And so I noticed like, hey, I know you don't want to fix the roof, but give me credit at the closing to go and fix that roof, right? And the roof needed to be replaced in about 2 or 3 years. And I'm like, hey, give me a credit. So that $10,000 credit that I got ended up covering my total down, like almost all of my down payment, right? So I was able to get $250,000 of real estate completely for free almost. Of course, I had to fix the roof in like 2 or 3 years, but I'm estimating that the rental income from that will cover enough to replace the cost of the roof. And what I'm doing on the back end is something we'll talk about later, is doing a cost segregation study on the property itself, which is going to generate me tax savings when it comes to my return. So net effect of the property being able to take the tax savings, it's almost like I got paid $4,000 to buy the property, if that makes sense.
Well, congratulations. That is awesome. I mean, to get paid $4,000 and now have a roof over your head. Is there a tenant in place already on the other side? Have you guys moved in yet?
Yeah. So I haven't moved in yet, actually. It's currently rented out. There's 2 tenants in there.
Okay.
And the one that I'm moving into, the tenant's leaving in a month or two, couple months.
Sweet, man. Well, cheers. Congratulations to that. That's exciting.
Cheers. Yeah, it's called house hacking. I talk a little bit more about it on my Instagram. There's tons of people that are into house hacking. I think from a wealth building perspective, it's the best way to start, cheapest way to get involved. And what's nice about it is you can kind of rinse and repeat. Once you get up to 20%, you can refinance out and do it all over again. You only have to live in the property for 1 year to be able to do another FHA loan at 3.5% down. So not sure if I'll do another house hack or not, because I'm eyeballing like different investing opportunities, but it was a great way to get started.
Yeah, no, I mean, it gets you in the game. So how does, I guess, tying it back into tax questions and things like that, how does a house hack, doing a house hack, does that automatically make that property now, or at least a portion of that property, an investment property? So is it like 50% of everything?
Yeah, exactly. So it's pretty much broken out depending on the usage. So if I live on the bottom floor and there's a tenant in the top floor, I have like a multi-use property, right? So I'm only going to be able to take the expenses allocated towards the tenant's part of the property on my Schedule E on my rental tax return. Gotcha. My personal expenses are only going to be deductible if I qualify for what's known as itemizing on my tax return. But any expenses that are allocated towards the tenant, so I get the tenant's portion of the depreciation. I get the tenant's portion of the utilities if I front the bill. I get the tenant's portion of the mortgage interest, the property taxes. Everything's kind of allocated between personal use that I use myself and then the tenant's use.
Gotcha. Okay. Perfect. So I mean, so it sounds like then house hack is like the easiest way to not only take care of the roof above your head, but also to get that first stripe on your real estate investment bill.
Yeah, and it's not going to make you. It's by any means not going to make you like blow out of the water and make you rich, but it's going to get you started. It's going to get you used to being negotiating deals. I mean, I did a little negotiation talking with a few like realtors just about the strategy, like coming to close and doing the contract offerings. Learn a little bit there, and just the more you learn, it like get your feet wet. It's not going to make you rich, but and again, like I'm not going to be able to live rent free completely. Now, if you house hack like a quad or a triplex, then I've seen people actually live for free doing that. But, you know, my mortgage payment still comes out to be $350, $400 a month. Given the average person my age spends $1,400, $1,500 to live in the city, and I spend a third of that. And again, that's back to being like frugal and not being cheap, but being frugal, right?
So I get a question for you, because I feel like I'm a pretty like frugal person. How do you define frugality versus cheapness?
I think frugal is like knowing that you can afford something, but deciding to go with the cheaper option instead. So like I know I can afford like $100 bottle of whiskey, right? But I still buy my $30 bottles anyway. Like I know I can afford a new BMW, right? But I still drive my 2010 car, right?
Yeah.
That's what being frugal is understanding like, hey, I can go and be like the Joneses. They talk. 70% of America can't afford a $1,000 emergency, right? Half of America doesn't have money saved in retirement. Like there's a difference between being frugal and being cheap. And being frugal is just knowing that like, hey, I can afford this, but I'd much rather save my money.
Which why I'm sure the whole tax thing played out to you, because now, right, you can be as frugal as you want with the most wealthiest people ever who are also very, very frugal. And then, there's ways to get nicer things or pay for nicer things that necessarily, obviously are kind of incentivized by the tax code.
Yep.
So let's jump into some of the questions that I sent you before and some that I got on Instagram. So just even, I feel like a lot of the clubhouses and things that I've seen recently on Instagram, right? Obviously, as the year wraps up, a lot of people are thinking about taxes for next year, and I know that for the most part, a lot of CPAs calendars are already they're booked for the tax season now. So you should have already booked your appointment yesterday with your CPA, or at least really started to find some, months ago. But for those who obviously are just starting the train, how would you recommend someone to find? Of course, they could reach out to you. I know that you have, I'm sure you still maybe have some open spots for consultations. And actually, maybe first, are you a tax strategist, or do you still file as well? And what is the difference for the listeners?
Yeah, so I would say, I do both. I do the strategy and the filing. The difference is what you see in people. So to sum it up, like rich, I would say we'll call it wealthy and upper middle class people. They know exactly how much they're going to owe or get back on April 15th before April 15th. They are going to know before the year's already over, or they're going to know like a few months before the tax deadline. Poor and lower class people, they find out how much they owe on the tax deadline. And that all has to deal with tax planning. So tax planning season is actually months before the year's actually over. Because if you come to an accountant, let's say for 2021 tax year, you come to an accountant in February or March of the following year, there's little to nothing that we can do after the year's over to actually help you save money, because the tax year is on a calendar year, January 1 through December 31st. Only things done in those days are going to actually save you money. Sure, we could tell you, we can make sure that you don't pay as much as you need to, or we could say, hey, this is how much you have to pay per what you did the following year. But after December 31st, all we could tell you to do to save money is literally to invest in an IRA account or an HSA. Like that's all you have. That's all you're able to do after the year's over to actually save you money. So again, it comes down to tax strategy and planning versus if you're just somebody that, hey, I'm just going to hand my paperwork into somebody before April 15th and they're going to file my taxes. That's not, if you're working with a CPA and that's all that they do for you, you're not actually working with the CPA. You're just handing your stuff in to have them prepare. You need to actually be setting up meetings in 30-minute meetings to figure out your strategy throughout the year. Because there's some people that they know as soon as this year's over, they already know how much they're going to either owe or get back come April 15th.
Gotcha. No, that's really good advice. So how would you recommend, say someone obviously just closed on their first rental property maybe a month or two ago and is now like, things are a little bit different for me than before. How would you recommend someone find a CPA?
Yeah,
or strategist?
You really want to just obviously make sure that they do what you do, right? If they're a CPA, but they're just like a generalist and they don't have a specialty in real estate, or maybe you have a small business, are they a special? Do they specialize in small business? Find somebody that like loves to teach what you do. So, for example, like
Mhm.
I love to teach about personal finance. I love to teach about real estate tax, right? So it's like a
Mhm.
perfect mold. And I also now invest myself. And
Mhm.
I would say it really depends on what you're doing with the property, right? Because if obviously if you're just a homeowner, then it's not a rental property, right? It's just you're owning a
Mhm.
home. If you house hack, you're going to want to get with somebody to kind of walk through what I just talked about. If
Yeah.
you own a short-term rental, you're going to want to talk with somebody because as you know, and most of the listeners might know, that short-term rentals are taxed differently than the long-term rentals. It really all depends on what you have going on. I will say this though, of all the self-prepared returns that I've seen, like somebody prepared the tax return the year before, I've only seen one guy get it right, like
Hmm.
completely actually get the correct depreciation, the correct basis, the amount of expenses. Everybody else that's done it, they've overpaid in taxes, or they've taken way too many deductions, and they're on the risk of being audited. Right? I've only seen one guy do it. I won't say his name, but he had an accounting degree, and that's probably why he got it right.
Oh,
So
well, that would, I'm sure, help a
yeah,
little bit more than the average Joe.
yeah, exactly.
Um, okay, yes. So they should be talking early and often. And I feel like, for whatever reason, right, when you're, as an adult, you would do it all yourself through TurboTax or whatever else it
Mhm.
is. I mean, if you just have a W-2, it's pretty easy for all the
Oh
standard
yeah.
stuff. But the moment, we start having, a couple investment properties, I guess how many properties would it say on your first property? So this next year that, you should be really getting a CPA, is that enough? Or, what is your professional advice?
hmm Um, I think if with the first property, it's enough to have a conversation with somebody, not
Hmm.
necessarily maybe get your taxes prepared, but actually understand what's going on. Because even on one property, the same laws apply with whether or not you bought a $200,000 property or a $500,000 property. You still have to
Hmm.
go in there and figure out your expenses, calculate your building basis, calculate the land, figure out you still have to know those passive loss rules that I talk about all the time. So
Hmm.
whether or not the purchase price, of course, even though it could be double or triple the amount, the same kind
Yeah.
of same laws apply. And so that's why I say, even if you have your first one, it's something to have a conversation about with somebody.
Okay.
And it doesn't have to be a CPA. It could be an enrolled agent. It could be a different tax advisor. Just the CPA is more like I would say, an accountant on steroids. And we're licensed and accredited by different governing bodies. So we're more than just we're like a notch above just a tax preparer. Obviously, we're licensed, governed.
Hmm.
Mhm.
Gotcha. So, and then you mentioned something earlier that your long-term rentals are very different on a tax basis than your short-term rentals. Can you break it down real quick
Mhm.
for the audience on how they differ?
Yeah, right. So basically, any income that you make, it gets lumped into two buckets. You either have earned income from like a day job, a W 2, a 1099. Your
Hmm.
stock income comes into here, your ordinary income. And then you have passive income. Passive income is either real estate by default. So all rental activities are by default passive. They get lumped in that passive bucket.
Yeah.
Or any activity in which you don't materially participate in. So if I like invest in my friend's laundry business and I just sit back and collect cash, that's a passive activity. Okay. So we got ordinary activities, we got passive activities. The biggest difference being the passive activities are not subject to that working man tax, the
Hmm.
self-employment tax, which is like an additional 7.65% on your wages. So if you look at your W-2, you'll have a line item that says Social Security and you'll have one that says Medicare.
Hmm.
Passive income and real estate is not subject to that. Okay. So
Hmm.
just kind of breaking down the basics. Now, what that also means though, too, is a loss from a passive activity can only offset that earned income with a long-term rental if you qualify as what's known as a real estate professional. So
Okay.
there's a tons of talk about what that means, and it's not just as simple as like getting your broker's license and saying you're a real estate professional. You have to meet a pretty strict hours requirement, where if you have any sort of day job, W-2 job, like me, I'm an accountant, right? I would have to prove that I spend more time in real estate than I do as my time as an
Oh,
accountant. Which
interesting.
if I spend 2,000 hours as an accountant, that would mean I had to spend 2,001 hours in real estate.
Hmm.
I do work 80-hour weeks, but not every time. Okay, because working 4,000 hours a year would come out to be 80-hour weeks, right? Um,
Gotcha.
And so you can only take that long-term rental loss against your earned income if you're a real estate professional or you make less than 100 grand. Okay.
Mm.
So for the people that are just starting off, that maybe they buy their first investment property and their income is below that 100 grand mark, they can take their rental losses against
Mm.
their income. But I mean, most of the clients, they're making more than 100, more than 150. So they're not going to be able to take any long-term rental losses against their W-2.
But I think I've never heard that 100 grand rule before, and I think that's really interesting, especially for rookie investors, right? I feel like once you have a
Yeah,
few under your
exactly.
belt, you're
Mhm.
definitely, probably over that 100 grand threshold.
Mhm.
But,
So that phase out, just so everybody knows, it's between 100 and 150. So if you make below 100, you get a $25,000 loss against your income if you have it. So
mm,
let's just say let's say I make 90 grand, okay,
mhm,
and I have $25,000 of rental losses. Well, I plug that 25 grand, that loss, into my tax bracket, and this is kind of like what I did with my house hack.
yeah,
Is I plug that loss into my tax bracket, and I end up saving $6,000 by doing so because I qualify for that because I make less than 100 grand, right? As soon as you start making more than 100 grand and you own long-term rentals, it starts getting what's called phased out until ultimately, if you make more than 150, you don't get to
mhm,
take any sort of passive loss against your income.
gotcha.
Okay. So basically, long-term rental rules are, if you make more than 150, you're not going to be able to take any sort of loss. Okay.
Mhm,
Right, if you make less than 150, you're limited on the loss that you can take. Okay.
okay.
um, Unless again you qualify as a real estate professional. But most of us that have day jobs in tech, nursing, accounting, like, we're not going to be a real estate professional because we don't have enough hours in the day. But then we switch over to short-term rentals and how they're different, right? So
Mhm,
those same sort of rules, and like what I talk about is the short-term rentals are not considered passive rental activities under the same code section that you find that $25,000 loss rule and real estate professional status. So basically, all you have to do then is prove that the average tenant stays 7 days or less. So if you add
mhm,
up all the total days that it's rented out divided by the number of guest days, I said tenant, I
yep,
meant guest. I get tenants and guests confused sometimes. Um,
that's all
right. So
right.
7 days or less, and you
Mhm,
meet one of those material participation tests that I talk about. If you can do that, then you can take your short-term rental loss, which for some people it's 50 grand, some people it's 100 grand, some people it's 250 grand. You could take that loss against your income, um, to the point where the average person, I would say, that's in, like I would say between a 24% tax bracket up to like a 35%. So like your normal, they call them Henrys, like high earning something professional. I forget
okay.
exactly what it is. But your average, like high earning person that places into service, say, a $500,000 vacation rental, they're getting 35 to 50 grand back by doing
Wow.
this strategy. Which, if you do the numbers on a $50,000 cab, on a $500,000 cabin, if you put the 10% down, the secondary home loan, you're getting like pretty much your down payment back.
Yeah. No, that's significant. I mean, I'm just thinking about, the one that we're sitting in right now, like we put in,
Mhm.
I bet you like 115, 120, right?
Okay.
Which is a lot to park inside. I mean, fingers crossed permitting goes well and all that stuff, right?
Mhm.
But that's a lot to park. But to be able to get a majority of that back after the first year is definitely something that we want to look into for next year.
Right.
Um,
And
no,
that's what it is. It's like an arbitrage play of, and then again, that's how the tax code incentivizes all this, because you're by you buying a property, you're hiring lawyers, real estate agents, people at the
mhm,
closing table, right? And then there's going to be people that, rent your cabin, which is going to bring economic activity to that area, and that area is going to boom because there's people that rent in that area now, right?
mhm,
And so that's all the incentivize, and to incentivize you to do so, that's where the tax law comes into play, right?
gotcha.
Hmm.
So, okay, now what happens now if I have a partner in this property?
Hmm.
Would we have to put it in a joint LLC for us then to get that split back, on like a K1 or something, or how does that work?
Hmm. Yeah. So the way a partnership works is, like, let's say you and I both want equity in a property.
Mhm,
So let's say we both put 50 grand down. We're partners in a partnership. So we
mhm,
would file a partnership tax return
yep,
that gets submitted to the IRS, and we would each get our own K1 form that
mhm,
reports our share of the earnings of the rental. If we're 50-50 partners, we obviously both get equal split, but you can actually be 50-50 partners with somebody and have no money in the deal. Like, let's say you put in the capital.
Yeah.
Let's say you put in the capital, but I put in the legwork and my accounting services. Like, we could technically be 50-50 partners, even though I don't have any cash in the deal. I'm providing my services to the partnership.
As long as the operating agreement says that on the output, you guys are both 50-50, right?
Right. Yeah. And that's a good point, is you really want to make sure that anytime you invest with somebody, there is an operating agreement in play. Typically you'll have a lawyer preferably draft you this statement. When it's pretty basic and there's just two people coming together, you normally have like a 50-50 split, or however you split it based on capital. When it gets more complicated, and let's say you have 4 or 5 investors involved, then you look into stuff called like a waterfall allocation, where it'll be, hey, the limited partners get the limited partners are going to get this percent until they get their money back.
Yeah.
And then the GPs will actually make money on top of their service fee after the limited partners kind of get their capital back. So really important that anytime you invest with somebody, that you want to have that operating agreement into play, because it's going to outline the good, the bad, the ugly about what goes on in that partnership activity.
Gotcha. No, I mean, that's super smart, obviously, and it just helps everyone, right, with the peace of mind, so that everybody's protected down the road. But that is definitely good to know.
And that'll also outlay too, is like, let's say we have a rental for 3 years and you want to walk away and sell it and cash out, and I want to hold it. Then what do we do? Right. It's all going to be in the partnership agreement. Because like, we might be really good friends now, but like, when you want to walk away and I want to stay, what do we do? Well, it's already in the agreement. We already have a legal binding contract that's going to say what happens in the event that somebody wants to leave and somebody wants to stay.
No, I mean, it's just a helpful fail-safe, and so that way you just have your governing bylaws, or whatever you want to call it, right?
Yeah,
old school. Okay, so the next question that I got is, when should you get an LLC or an SCorp? Obviously, I know that this is all very situational, right? But say you had your
the
average
LLC.
Joe.
Yeah, the LLC. If you have a partnership, you're going to want one. You're going to want an LLC, right? If you're just a single owner, so like, I don't have mine in an LLC. It should be a question for an attorney, but it all comes down to like, what can you afford to lose, right? And this is how I answer that question, is like, no, let's say I have $100,000 net worth, and 30 grand is tied up in real estate of my equity. 30 grand is in real estate. The other 70 is in, say, cash or retirement or whatever it is. So my allocation of real estate versus my total net worth is only 30%. Do I need it in an LLC? Like, it's only 30% of my total allocation, right?
Yeah.
Now, if you flip that on its head and say, hey, I got 70% of my net worth in real estate, and I only got 30% in securities or liquid assets, then it's time to like have that conversation of wanting like further asset protection. But I would say for your landlord, like, starting off, you would be okay with a high umbrella policy covering your rental. But again, this is not legal advice, because I'm not an attorney. I'm just a CPA.
Yeah.
But that's kind of how I work with a conversation with people.
Yeah. No, I mean, that's one thing I definitely learned, right? Is obviously, one, is a risk tolerance there, right? The LLC really is just a liability umbrella, not so much. It's like the pass-through tax entity, right? And so, yeah, I think when it comes down to, how that's structured, having both the, an investor-friendly, savvy CPA in your corner with, also a savvy attorney is obviously the best combination, right?
Yeah, and the answer you're going to get from both of them is always, it depends, because we have to like look at your facts and circumstances to determine what the best outcome is, like the best strategy for you. Because an answer that I give to somebody may not be the same answer for the other person, even if they have similar fact patterns, right? They could be making the same amount of money. The answer could be different depending on the individual's tax rates, depending on the individual's goals, like their future. What do they want to do in the short term? What do they want to do in the long term? All that factors into that tax planning and strategy.
So what about the SCorp question now? Because that now transfers a little bit more, there's a little bit more tax implications to that. When do you recommend people to do the SCorp?
So you should never have rental real estate inside of an SCorp, ever. Okay. So your SCorp should never own a real estate property, a rental property. And the reason being is because, first off, we go back to that analogy, right? You have earned income and you have passive income. So earned income being your wage that you work for, passive income being real estate. again, and we talked about that passive income is not subject to that Social Security and Medicare tax. One of the primary reasons people set up S-corps in the first place is to work around that Social Security Medicare tax. But you have rental real estate, which isn't subject to that tax anyway. So setting up an S-corp is not going to save you on that side of things. And also too, when you have an S-corp or a C-corp and you contribute real estate or any sort of appreciating asset, like an asset that goes up in value over time. So typically real estate, it's like the only one that goes up in value, unless it's like a stock or Bitcoin. But when you contribute assets to an S-corp, or when you distribute them out of an S-corp, it can be a taxable event sometimes, most of the time. And that's the thing that a lot of people aren't ready for, because what a lot of people will do is they'll buy something in their personal name, deed it into their business, and then when they want to refinance, they'll have to pull it out. Well, that if you have an S corp or a C corp and you pull your real estate out of the corp into your individual name so you can get preferable financing, that's a taxable event. And a lot of people aren't familiar with that. So if you take anything away from this call, you never want to have rental real estate inside of an S corp. Now, I said rental real estate. If you fix and flip real estate, so like let's say I go out and I buy properties and I fix them and flip them, that activity is subject to that Social Security Medicare tax, that FICA tax. So in that case, if I'm fixing and flipping real estate, I do maybe want those in S corps. It all depends on what the use of the tax in the hands of the taxpayer is. If I'm just buy and hold rentals, I don't want them in an S corp or a C corp. They should either be in LLCs or partnerships. Okay. If I'm doing fix and flips, maybe I want them in an S corp. Maybe though.
That was a very simple, easy to understand answer. Thank you.
I try my best.
No, that
so
was
never hold rentals. Never hold rental real estate in an S corp.
Okay, how about this? Using a solo K. Okay, first, what is a solo K? And then if someone's using a solo K to invest in real estate, are there any things to look out for?
So what the government loves people to invest in real estate so much. They love it so much that they'll let you take money out of your retirement account, your IRAs, your 401ks, whatever you got. Even people who have like military or teachers retirement, they'll let you take money out of those accounts to go and buy real estate in what's called a self-directed IRA. So the substance of your account remains the same. Like let's say I have 50 grand in a employer 401k. I make that into a self-directed IRA that's going to go and buy real estate. So instead of investing into Wall Street and, I don't even know who these guys are that are investing my money, I can take the money out of my retirement to invest in something that I know and understand and that I love, which is real estate. So the self-directed IRA allows you to kind of tap into your retirement and use it and it's not just real estate. You can own crypto with your IRA account. You can own businesses. So I'm actually thinking about the idea of self-directing my solo 401k and investing in a friend's business with it. So there's tons of things you can do with this account. And I think with tech and just the majority, there's going to be a huge transfer of wealth from boomers to like our generation. And I feel like the traditional investments of boomers is way different than what we like to do. Like we like, financial freedom. We like crypto. We like, so I think you're going to see a lot of people start self-directing those accounts that their retirement account. And real estate is just one of the things that you can do with it.
So when can someone do that? So say, they're at a job, they have that 401k at their job, but they're still, in that, they've been working there for 5 years, which I guess in this day and age is a very long time, but have a significant amount saved in there, right? Do they have to wait until they leave their job to then roll that over into a self-directed IRA, or how does that work?
So that's actually going to depend on their employer plan. I would say most of them don't allow you to while you're still working at the company. And here's why, is because if I take that money out of my 401k that's in Wall Street in the stock market and I put it into real estate, guess who's not getting agency fees anymore or commission on my investments? That 401k plan, right? So they're not going to let you, I would say like 90% of the time, if you're at an employer, they're not going to let you roll that to a self-directed IRA right away. So a lot of people, I wouldn't tell you to quit your job just so you could do the self-directed IRA by any means. But what you could start to do is, like, I have a Roth IRA account, which is independent of, I've had this when I was an employee and I've had it after I was an employee. But like your traditional IRA accounts that are separate from your your employee plan, those are free game. Like you could convert that IRA account whenever you want to a self-directed IRA.
Gotcha.
Mhm.
Okay. No, that makes a lot of sense.
Mhm.
Next one, bookkeeping. Um, a lot of people, a lot of especially newbie investors, including myself, are using Stessa for
Yep.
bookkeeping. What do you recommend? Should we hire a bookkeeper off the bat? Like, what do
Mhm.
you think?
Um, I have my own property. I use Stessa for my bookkeeping. It's very investor friendly. It even you can type in your property address, as you know, it'll show the property.
Mhm.
It'll actually calculate the investor metrics for you too. So it'll break down like cash on cash, ROI, IRR. It'll break down all those numbers for you also. And
Mhm.
it's as simple as getting a separate credit card or a separate business account for that rental, linking it with Stessa, and just make sure you swipe everything on that card. And the
Mhm.
the computer, it'll feed in all the transactions and summarize everything for you. And if you do it enough, it'll start to actually know what you're spending money on. So if you go
Hmm.
to Home Depot for a bunch of stuff, it'll know like,
Yeah.
hey, this is like repairs and maintenance or supplies, right? If you go pay the utility bill, it'll say, hey, this is the electric bill. If you go to pay the property taxes out of that account, it after a while it starts to recognize the transactions, and then it'll kind of run itself.
I do need to clean up my Stessa, though, I will say. Probably
Mm.
sooner than later. Okay. How about this next one? Actually, this is the last tax question that I have is what is your favorite tax hack for investors other than 1031 exchanges?
Hmm. So, I mean, my favorite one, it has to be that short-term rental material participation strategy that we just kind of walked
Hmm.
through. I mean, you're literally the government's paying for your short-term rental. Like, outside of that, what I really like to do, I enjoy. It's a little bit more complicated, but it's what's known as a partial asset disposition.
Hmm.
I don't want to go too into detail, but basically, like if you have, I have a roof, right? I have a roof on
Yep.
my property, okay, and the roof is depreciated over a certain amount of years. We
Yep.
good?
Go ahead.
We
Sorry.
good? But like when I go to buy a new roof, right? And I put a new roof on, I obviously replace the old roof and then put the new
Hmm.
one on, of course. But what a lot of investors don't do on their tax return is actually remove the cost of the old roof off their balance sheet, which creates
Oh.
tax savings. Because let's say I have a roof and I've had the rental for 3 or 4 years, and now I need a new roof. Well, I'm
Hmm.
able to remove that old roof off my balance sheet to put the obviously got to buy the new roof. So not only do I get an expense for the old roof, but I get to put the new roof on and start depreciating that new roof. And the reason being is they don't want you depreciating more than one roof. I've seen tax returns where people are depreciating 3 or 4 roofs at the same time.
Oh, wow.
So, because like they've owned the property for 18, 20 years and they've needed
Hmm.
more than one roof. So there's like 3 line items for roof on there. Um, so yeah, it's partial
Interesting.
asset disposition. It's a little bit more complicated, but I would say yeah, favorite tax hack has got to be accelerating the depreciation, especially if you're a short term rental owner.
Yeah, that one, you have a webinar, and I'll, when I re-upload this and you're watching this on the post play, I'll put the link to your webinar that you have linked in your Instagram there. That
Okay.
was the bet. Like, that's the one that just made me like, oh my God, this Ryan guy is like amazing, right?
Mhm.
Where we can figure out how to offset the taxes that we pay as a W-2 because of short-term rental, because that passive active thing is just.
Because normally, if you're a long term rental investor,
Mhm.
which you were at first, right?
Yeah, well, this is still my rookie year. I've actually not
Oh,
filed taxes yet
oh, right,
for
right,
real
right,
estate.
right, right. But like
Um,
those long term rentals, like you're not gonna be able to do anything with those losses. Those
mhm,
losses are gonna get kind of trapped and suspended. They're carried
mhm.
forward. But like the loss generated from the short term rental, you're gonna be able to use to offset your W-2 income.
Well, I'm excited because this was not a cheap room.
uh,
Um,
yeah, it's great. No,
okay, and
what are we
then
what are we moving on to?
let's go to the social media marketing questions. That's my little niche that I love to just talk about other business owners with. So for this one is always an interesting argument. But do you have separate personal and business social media accounts, and
Yeah,
why?
I do actually. I had an Instagram that I've had for like 2012 maybe, that
Hmm.
has like all my posts going back to like freshman year of high school. And then
Hmm.
I actually created Learn Like a CPA this year, actually beginning of this year, January, and it's already scaled to 5,600 followers.
Dude,
Or was it
you've done
January or
awesome.
the year before? I can't remember. I do have separate accounts, just different. I didn't want to get all the personal people involved in what I was doing, but a lot of my friends follow me anyway for advice. I actually have people that followed me from high school that I haven't talked to in years that actually will ping me, reach out, and just ask like a financial or a tax question. The financial
Yeah.
questions I'll answer. The tax questions not all the time. I'm like, get out of here. You just want free tax advice.
Well, you also need more like context, right? So it's really
Mhm.
hard to give accurate advice. I'm sure
Oh
some
yeah,
stuff you could
it's
just be like,
so yeah. Sometimes I'll get a just a 2 sentence question like, I'm buying the short term rental. Should I do a cost seg? I'm like, I have no freaking idea. Like I don't know your income. I don't know how much you bought
Mhm.
it for. I don't know your goals. I don't know anything about you. But when it comes to tax planning, I need to know everything about you. I need to know, your current income. Are you going to
Yeah.
lose a job soon? Are you planning on cashing out 401k? What did you eat for breakfast? Like I need to know everything about you, so that way we can do tax planning.
Yeah. No, that
Mhm.
makes a lot of sense. Okay, I guess the next one is, what are your goals with social media and marketing?
I just want to put as much valuable content out there in the hands of people so they can take action. You'll see, like I try not to all my posts are videos. So it's me
Mhm.
speaking, it's me engaging with other people. And it's not just like your regular, hey, here's a post about IRA accounts, here's a post
Mhm.
about retirement investing, because I could show you the graphs of say, hey, if you invest $200 a month for 40 years, like everybody can run through those numbers, but I actually like to provide context in my videos. So that's why all my videos will be me speaking, me walking through the concepts, the scenarios, and it's just pretty much valuable content that's different from everybody else because I don't see a lot of people actually sitting down and doing videos. I see the little posts and stuff, but I don't see
Mhm.
people. And my marketing is very basic. I gotta connect with one of my guys, but it's literally just the title and then a video. That's it. Like that's all you're gonna get from me because I'm basic and I just want to give as much value. And I've had people reach out to me and they say like, you actually provide the most value on Instagram, but your marketing is shit. And I'm like, okay, I mean, thanks. So maybe I need to do better marketing, but I mean, at least it's that value perspective of like when somebody watches one of my videos, they're just like, I had no freaking idea about this, or
Yeah. Yeah, I will say that you give, I mean, very thorough, very transparent tax advice. And for your friends and for anyone else who DMs you, if you just spent, I don't know, 5 hours consuming your videos, you could probably get baseline answer of most of your questions
hmm
because your webinars are very specific. And then
hmm
obviously you can just now pay for a consulting session just to get into the nitty gritty a little bit. Um, I will say yes, from a marketing side, yeah, the videos could get spruced up a little bit, but the reason why you're still like
okay.
selling, is because, and this goes to anybody. And as I talk to people about who are syndicating or whatever it is, and they're talking about their marketing, like, man, I don't have the camera, I don't have the mic, I don't have the whatever. Like I'm in a very dimly lit place right now,
Mhm.
right? I'm the marketing guy, but it doesn't matter what you shoot with, just as long as you make something that over delivers in value, it's gonna deliver. And hence
Mhm.
why you've already grown Instagram significantly since you've launched.
Mhm.
Um, the moment it is polished though, man.
Yeah, maybe I gotta connect with you offline and get that squared
uh,
away.
I love it. Okay, so this is the last part of the show. I call this the last call. Just some odds and ends, just so we can get to know you a little bit more, Ryan.
Mhm.
So what is your favorite or most valuable real estate or just general advice that you've gotten in general?
Don't wait to invest. Invest and wait.
I
That's
like
it.
it. That's
Because
everywhere.
yeah, that and it's basic, but it's very true. Like the moment the longer you sit on the sideline and say, "Hey, can I get 10% here, 12% here, or what can I get with this real estate deal?" The longer you're on the
Mm,
sidelines, the less you're in the game. And a
mhm.
lot of people will say, "Oh, so and so got lucky, so and so did this," and like you go from zero rentals to how many?
6 properties.
6 properties, right? A lot of people say, "Oh, that person got lucky because how are they able to go from 0 to 6 in 1 year?" The person who takes a lucky shot had to be in the game at one point. So if you're sitting on the sideline, you're never in the game to take the shot. And normally it's the people that work the hardest, the people that work beyond their W-2, that go out of their way to network and meet people that get quote unquote lucky. And you just have to be in the game to start. Um, as far as practical advice, investing advice. contribute to Roth accounts early if you're investing in retirement.
Mhm.
You're never going to be in a lower tax bracket than you are right now, because as you move on in your career and your profession, you're going to get paid more. It's just the nature of the business. And plus, I
Mhm.
think tax rates are going to go up too, just with all the deficit spending, the inflation, the stimulus bills. I mean, the government's pumping money into the economy, and it's jacking up inflation.
Yeah,
So I want everybody to, max out that Roth IRA if you can, and just start investing in Roth assets. Yeah.
I love it. Okay, the next
Mhm.
one is, what was the most memorable drink you've ever had? What did you drink? Who did you have it with? And what made it so memorable?
Hmm. That's a good question. I mean, I do enjoy like celebratory drinks with people. So I remember
Mhm.
like the last big one I had was when I did pass my CPA exam and I was
Okay.
all done with it. I invited a bunch of my friends to come
Mhm.
out. I actually paid for the tab. It only ended up being like $200, but I would say that was pretty enjoyable. And then I guess it was also just like drinks with family that I don't see often.
Yeah.
Favorite drink though is favorite whiskey. I like Bullet whiskey. Again, that's like in
Okay.
the $30-$35 price range. I haven't
Yeah.
had like I haven't had like a really good whiskey where it's like, okay, I'll pay the $80 to drink the bottle. Um, but that's just me being
You're
me.
not reaching for like top shelf Macallan or something, huh?
No, I mean, I could jump up and get it. I used to play volleyball. I could jump up and get it on the top shelf, but I just, again, it's just back to being frugal. Just back to being frugal.
I like it. I like it. Well, so any of your clients who are listening, the holiday gift for Ryan is definitely some nice whiskey then. We'll fill
Mhm.
up that closet real quick. Don't worry.
Yeah, I do need some more whiskey. So I'm really dry here on the Maker's Mark.
Okay, the last question I got for you, Ryan, is what's next for you and how can people add value to you?
So I'm there was an interview with Will Smith. Somebody interviewed Will Smith and they said, what is your like what would anybody that listens to what you have to say, like what do you want them to get from it? And he goes, I have a life purpose mission statement. He goes, I want the world to be a better place because I was here. That's his mission statement in one sentence. I want the world to be a better place because I was here. I have that same sort of standard of like, I want people around me to feel energy and I want the world to be a better place. But in
Mhm.
my niche, in my profession, I help people scale their rental portfolio using the tax code. And I not only am I there, but I'm also there from like a coaching perspective. So then,
Mhm.
we kind of walk through that conversation of retirement versus real estate, or this rental versus that, all those sort of questions. And with some of my clients, it's almost like not even a business relationship. It's more like a personal person. Because I have some
Mhm.
people that will just text about weightlifting or about what we eat as a diet or what we're doing this weekend. And it's way more personal than I would say your average CPA to person relationship, which a lot of people want it to be business, but I try to make somebody feel wholesome, and I want to include everything and just
Yeah.
be an open book to most people.
Yeah, no, I mean it's more than just that. Like you're selling them a service. I got this one from a Ryan Serhant's book. Gosh, what was his first book that he released called? His last one was like Big Money Energy, but his first one, Sell It Like Serhant, is nobody wants to be sold to, but everyone wants to go shopping with friends. Like that's like,
Mm,
that mentality of like, hey, can you make that other person that you're doing deals with, that you're, doing business with, like, do they really want to have dinner with you over and over again?
mm.
Um, it is something that, sticks in my mind every single time. So, hey, Ryan, thank you so much. I know that you have a fun dinner to get to.
Yep.
The last thing is, where can people find you?
Yeah, so I'm on Instagram, Twitter at Learn Like a CPA. Can I put that in my description? Or I guess you
Y-
could put it in the show
I'll edit
notes.
it on the post. Yeah.
Yeah, and then I'm in a lot of the real estate Facebook groups. So if you guys have groups and you want to add me and you want me to be your expert, subject matter expert in the group, go ahead and add me in there, and I'll just field tax questions. No guarantee
Dude,
on the answer, but or no guarantee on the timeliness of the answer, but I'll try to get back to you.
now that you say that, I'm a part of a clubhouse and I've been actively participating for a while. And you may know, I don't know if you reach out to some other people with it as well, but it's a clubhouse that's every Thursday at 6, not this Thursday because that's Thanksgiving. I'll text you more about it. But we were actually wondering if we can get a CPA on the call. So
Okay, I'm your
there's
guy.
like 20 to 30 guys. Yeah, I'll let you know. But you got to get to dinner. Thank you so much, man.
Yeah,
I really appreciate it. And I will see you on the next one or maybe on Clubhouse.
yeah. I'll see you later, Josh.
All right, man.
That was
Cheers.
great. Cheers.